Hello, this is Will Allen with Centera Capital. We are here in December, near the end of the year, but don't worry, we still have a couple more key videos to go. We want to just give you a peek that next week we are going to do our 2023 kind of report card video, and then the following week we have a really important one, the 2024 outlook, where we are going to go into the 3 key things that's going to determine what direction the markets go in 2024. But before all of that, today let's talk about some of the most recent economic data. Let's get into it. Before we get into the most recent economic data, just a reminder to like, subscribe, and share this video content if you have a friend or family member who is not getting these kind of updates. All right, let's get into the meat of what's taken place in the last week. The good news is that yesterday, the stock market hit a new closing high for 2023. It's continued to do well. And again, this has not been a surprise. We've talked about since early October the fact that the fourth quarter is typically been a really good stretch for the stock market. Some of the news items that have helped propel the markets over the last week. Last Friday, we got the most recent jobs report that showed that the economy added 199,000 jobs in the last month. That came in a lot higher than consensus. The unemployment rate dropped from 3.9 to 3.7%. A lot of economists thought it was actually going to go higher to around 4%. So that was a pleasant surprise. Now, looking beneath the surface in the employment data, the jobs data over the last month, something that we want to show you, we're going to put up this chart of the construction industry here. Take a look at, this is the total amount of employees in construction. This is now over 8 million. You will see this is at a new all-time high. Employees, 8 million employees in construction. And then take a look at this second chart, total construction spending in the United States. And again, this hit a new all-time high. Now, why am I showing these to you? The reason for it is that this is a very important sector as it relates to economic growth. In fact, if you go back over the last 50, 60 years, a lot of times as we have headed into recessions, this starts to trend lower, meaning construction spending drops and employees in construction drops. And as you can see from those charts, there is no hint of a decline in either of those. And so that is really an important point as you look beneath the surface of the most recent report. Another thing that we want to mention here is that wage growth, and we'll put this chart up for y'all, wage growth in the most recent report showed that employee wages were up, I believe, 3.96% year over year, which, as you can see, that has come down from where it has been over the last year or two. This has been trending lower. But the good news is that this is now, because it's now under 4%, the Federal Reserve is okay with wage growth being in the 3 to 4% wage. They want to see the inflation rate down around 2%, but they're okay if wage growth is in the 3 to 4% range, and they have that right now. All right, let's go to topic number 2, which is inflation. So as of this week, and we're recording this on a Tuesday, we got the most recent inflation report this morning, and let's put that up there that you can see that, and this is our trailing 12-month headline inflation both with alternative shelter measures and without. So without, the headline CPI came in at 3.12%. That is a positive. That is, again, one of the lowest readings in the last 3 years, and the Fed wants to see this at 2%. It's not quite there yet, but it's a lot lower than what it has been. Now, you may say, okay, what is, when you say alternative shelter metrics, because if you, by the way, on that chart, if you take a look, notice the alternative shelter metrics show 2.17%, meaning that the 2% target that the Fed has, we're nearly there. And so we've talked in numerous videos over the last few months about this concept of the fact that the Federal Reserve, when they are looking at headline CPI, the way that it's calculated, it uses a metric of called owner's equivalent rent, where they ask homeowners, what would you rent out your own house for if you were renting it to yourself for? And they use that number to help figure out what the inflation rate is. It is basically a made-up number. And so if you replace that with actual rent for apartments across the country and actual prices of homes that are sold. So, real life measures. If you use that instead, the headline CPI would be at 2.17% instead of 3.12. So either way, in both scenario, it is good because the inflation rate continues to go lower. Now, key point that I want to make, that was our big point in our video on November 15th, and if you haven't seen it, make sure and go back and watch it, because we addressed this point, that the first thing clients say when I say, hey, good news, the rate of inflation is lower, is they say, wait a minute, the things that I'm spending money on are still far more expensive than they were a couple years ago. And that's true. You're not crazy. Things are much more expensive today than they were 3 or 4 years ago. So again, we go back to the fact that price levels went up substantially in 2020, 21, and a lot of 2022. They are still going up today, but they're going up at a much slower pace. And so that's why the inflation rate is at 3.1, in the official data, 2.17. So prices are still going up, but they're going up at a lot slower rate. But again, consumer sentiment is negative relative to where you would think it would be, with the stock market at a high for the year and with the inflation rate doing better. A great jobs market, you would think consumer sentiment would be high, and it isn't, as we've talked about over the last month, because of the fact that price levels are still much higher than they were just 3 years ago. And by the way, one more thing actually on the inflation front. The reason that that's so important, and that while we day in, day out try to track that and other economic data points, is that one of our goals, and we have many with managing client portfolios, one of them is that we want their portfolios to outpace the rate of inflation over time, so that your money becomes more valuable relative to what inflation does over time. It eats away at the value of a dollar if it's not earning anything. So that's very, very important for you to know. All right. Our last key point for today's video goes back to the concept of seasonality, and we've talked about this before, in that the market has cycles and has history as far as how it performs during certain points during the calendar year, also during the presidential cycle, etc. And we take this into consideration when we're managing portfolios, and here's a reason why. Last November, mid-November, we had a blog post, and in it, we talked, and at the time, the stock market was doing very poorly. It was nearly at its low for 2022, which was a terrible year. And one of the things we mentioned is, hey, starting at the time when the midterm election happens, for the next 6 months, the stock market has been higher every single time going back to 1950. It was also the case that for the following 12 months, it had been higher every single time. And actually, now that we have had a full 12 months since last year's midterm, you can see here that the stock market has averaged a return of 15% going back to 1950. And guess what? For this last year, the stock market, the S&P 500, was up 16%. So again, this concept of seasonality, it was right on the money, and that's one of the reasons that we pay attention to it. And that was one of the reasons this year we did not go uber conservative in client portfolios, because we knew, hey, look, the seasonality, that was one of the factors that we said was in the favor of the markets. Another area where seasonality has mattered. In early October, we talked about the fact that though the stock market had tripped up in the August and September timeframe this year, which it had done the last 5 years, we said, hey, going back, the stock market's done really well in the fourth quarter. And so we thought that was going to be a tailwind for the market. And sure enough, the stock market is up nearly 10% since October 1st. That again has been a positive for seasonality. So what I'm going to leave you with today is 2024 and what the calendar says. So let's put up this chart. This shows you S&P 500 total returns during election years. So this is 2024. It's going to be an election year. And you can look back again to 1952. And you will see here that the stock market has been higher. On most occasions, there's been two exceptions, 2000 and 2008. Both times there were recessions. And you can see that the stock market was down 9% in 2000 and was down 37% in 2008. All the rest of the occasions, the stock market was up and many times did really well. Now, we, of course, do not have a crystal ball on whether there will be a recession in 2024 or not. And in our 2024 outlook in 2 weeks, we will talk in a lot more detail about what we believe is likely to happen in 2024. But we'll just say this, that there were a lot of economists, we call them recessionistas, who back in summer of 2022 began saying a recession was imminent. And they've been saying that ever since, at all times, okay? In 2023, we did not believe there would be a recession, and we've talked many times on why that was. The economy is likely to slow in 2024 from its growth rate in 2023. But as of right now, we still don't see in the next 3 to 6 months a recession. And if we continue to believe as we go through 2024 that we do not see a recession even into the back half, then the fact is that chart we put up about returns for election years is again going to be reason to believe that the market will have a tailwind in 2024. Again, we're going to talk a lot more in 2 weeks about our outlook for 2024 and about some of the other factors that, quite frankly, will go a long ways to determining how the economy does and how the stock market does. And you're going to want to make sure and keep on the lookout for that video here in 2 weeks and next week when we do our report card for 2023. Again, we hope you enjoyed this video. Don't forget to like and subscribe, and thank you so much for watching. Take care. Hey there, hope you enjoyed the video. Like and subscribe, but listen, if you are new to us, head to centeracapital.com. You can see our links below. The fact is, if you have your accounts, your portfolio with one of the large Wall Street firms and you haven't heard from your advisor, or if you're not getting the kind of info that we are providing here to our clients, then give us a call. The fact is, we can hop on the phone, set up an appointment, take a look, do a full review of your portfolio, and do a projection for you. So again, head to centeracapital.com and we'll see you there.